Hi, my name's Phil. I like talking about politics, and in this video, I'd like to discuss the Bank of England's decision to raise interest rates today by the biggest single hike in decades, why there's something a little bit off with their explanation. They say they're doing it to tackle inflation, but the particular type of inflation we have won't be reduced with higher interest rates. So what's really going on? But first, if you'd like to be notified of daily news and politics, please subscribe to the channel and click the bell notification icon. So the Bank of England has raised interest rates by 0.75% to 3% now. And yes, there'll be people going, oh, this is lower than the norm as it existed before the financial crash of 2008. And indeed it is. It's way lower than was the norm then. But it's the relative increase that does the damage. It's the fact that it goes up that does the damage, not what its base rate is. You know, when interest rates were typically, never mind 3%, 5%, even 6%, budgets were managed on that basis. Since then, the Conservative government has squeezed living standards to the point where people are not able to afford the hundreds of pounds extra that their mortgage payments will increase by. Some may remember the 80s and the early 90s when interest rates were well into double figures. But, well, apart from the fact a load of people lost their homes, mortgage and rent costs were a way smaller proportion of incomes back then. The problem with interest rates is not the figure itself, but what it represents in terms of a demand on your household finances. Incomes have been squeezed very hard by the Tories these last 12 years. The average income is much lower in real terms than it was under Labour, even after the banking crisis. It's gone down in real terms, a lot. So why has the Bank of England raised interest rates? Well, let's look at their stated reasons first. So the governor, Andrew Bailey, said inflation is too high. Low and stable inflation is the bedrock of an economy, he said. The target for the Bank of England is to try and keep inflation below 2%. So the in excess of 10% is clearly too high. But will raising interest rates bring it down? No, not at all. And it's fairly straightforward to understand. In terms of changing spending behaviours, interest rates work on borrowing. If you raise interest rates, you increase the cost of borrowing. So raising interest rates will dissuade people from, say, getting loans to redo their kitchen or build a conservatory, that sort of thing. So if there's too much spending on things like this fueled by cheap borrowing, then the bank can absolutely say, well, we'll increase interest rates to calm things down. But let's look at what's causing our inflation and see how interest rates affect it. So the Bank of England themselves, this is what they say is driving our inflation. The main reason they say is the price of gas leading to higher energy prices. That's the main driver of this high inflation. The fact that all of our energy prices are tied to the cost of producing energy from gas is a double problem, because about half of our energy is produced using gas. Russia's war didn't impact the other half of our energy production, but that went up by the same amount anyway, because it's all pegged to the price per unit of being produced by gas, because that's the most expensive way of producing energy. This is why energy companies have been able to carry on making record profits. But gas prices have been coming down a lot. Both the mild autumn and European countries that are taking the issue seriously, completing their stockpiling of gas for the winter, means less demand now. So the price is coming down. Besides, the war in Ukraine is going to have to come to a head at some point next year. Russia right now is advancing towards Russia. They continue to lose battleships to a country with no navy. Their air force can't even reliably hit the biggest country in Europe by area. And even Putin's usual allies seem to be sticking two fingers up at him at the moment. So there isn't a current or long-term problem with gas prices at this point. If anything, we're over the hill with it. So this major source of inflation is actually expected to be quite limited now. Besides, how does raising interest rates impact the price of gas? It doesn't. People aren't suddenly using too much energy and taking out loans to pay for it. This source of inflation was caused by supply problems, not a jump in demand. And people pay for it from their normal incomes, not borrowing. So increasing interest rates does nothing here. Plus, the issue will sort itself out without any intervention from the Bank of England, even without gas prices coming down. As long as they don't carry on going up, it won't drive inflation. Inflation is a measure of how much things cost compared to the previous period. Well, the current period is pretty high prices. So the next period, by definition, if the prices stayed the same, that would be zero inflation. You can't get much lower than that. So what else? The Bank of England says that there's a significant level of inflation from British businesses charging more for their goods and services because of the higher costs they face. So what are these higher costs? Well, energy is one, but like I say, interest rates won't affect that, and the issue is largely going away next year, in terms of the inflationary effect anyway. What else? Well, Brexit has imposed extra costs on businesses as well, but again, increasing interest rates doesn't help that. Higher wage bills and the extra cost of fuel for transport due to the high inflation, that will add to extra costs. But raising interest rates doesn't lower those costs for businesses. If anything, it can only increase them, because if a business needs loans to manage its cash flow, those loans will now be more expensive. In fact, on the wage bills issue, the bank says that there's a particular problem with labour shortages because there are more vacancies than people to fill them, they say. So many employers have to offer higher wages to attract workers. And that's it. The Bank of England doesn't cite any other significant source of inflation. There are some other sources, but nothing significant enough to be worth mentioning in this little report. None of them involve middle-class people in Surrey getting bank loans to pay for extensions to their home or a Thunderbird-style underground rocket launch pad or anything. Our excess inflation is almost all down to necessary price increases caused by shortages, a bit of profiteering on the side, you know, shortages of gas, shortages of workers, shortages of brains in government who thought that raising Brexit trade barriers would be a great idea. None of it is reduced by fiddling with interest rates. So whatever the reason for raising these rates is, it is 100% not to bring down inflation. So they're lying for some reason. But I'll speculate about possible reasons in a moment. For now, let's consider what does happen when you raise interest rates. And it doesn't matter whether it's now, when it's inadvisable, or during times when maybe there is an argument, because maybe lots of people are getting loans to increase their standard of living. So take people getting loans for, say, home extensions or Thunderbird-style launch pads, for example. If lots of people are doing that because the loans are cheap, the businesses who supply the goods and services for them make more money. They get more business. They've got more customers. And if there's very high demand, they can raise their prices as well. So they make more profit. And those profits are then taxed. So the government raises more tax revenues. If you increase interest rates, regardless of whether it's justified or not, the opposite happens. Fewer people pay for goods and services that they don't strictly need because borrowing is now more expensive. So they just manage on their own incomes, or more people just manage on their own incomes. Spending goes down, which means profits go down, which means tax revenues go down. It's obvious. If less money is being spent, less tax is being raised, the country's GDP goes down. So regardless of whether or not an interest rate is justified, raising interest rates has the effect of shrinking GDP. Now, if growth is strong, and you have some good reason for wanting to control what is seen as excessive borrowing, fine. But look at our situation right now. One, as I said, we have high costs caused by supply shortages of essentials, not an overheated market for luxuries. Second, the cost of living is applying a squeeze on even middle income earners. That means less money available for those luxuries. Three, interest rates going up means higher mortgages and rent costs, which means squeezing that income even more. Four, the Bank of England already believes that our economy is contracting and will continue to do so until 2024. And raising interest rates always has the effect of contracting GDP, always. So raising interest rates in the middle of a recession is generally not the way to go. So why are they doing it? Well, I've seen all sorts of economists speculating, some of them contradicting themselves, I think, a little bit. But I've not really seen anyone offering a credible reason why the Bank of England policymakers would want to. The only thing that makes sense is that the government are leaning on them to do so. Because although the bank is independent, I mean, it's only independent in the same way as other organisations like the police or the BBC, the courts and so on, you know, but a government that wants to lean on them has ways of doing so. And the government does work closely with the Bank of England, of course, and can easily get them to do pretty much as they please if needed. They decide on appointments apart from anything else. So why would the government want to create the conditions to worsen a recession in the UK as we head into a global downturn? Sounds like madness. I mean, you're not 5 years away from an election, they're 2 years away from an election. Well, if the Conservatives genuinely don't hold out much hope for winning the next election, let's say they're factoring that into their strategy, that they're probably not going to win, that the aim is maybe not to lose too badly, it could be strategically sound. Talk of recession and deficits means they get to wheel out austerity again. We know they're going to do that. Austerity is not the solution to any economic problem, by the way. No independent economist would support it. In fact, the UN have actually said that the UK adopting it right now could breach human rights laws. There's already too much of a squeeze without austerity doing it more. Austerity is basically a punch in the face. Now, if you're a hard as nails boxing champion, it's not pleasant to be punched in the face, but you can take it. Right now, British society is an elderly woman with osteoporosis. We cannot be taking the punch to the face in our present condition. There are those who suggest the government is going to do it to cause a serious collapse in public services in order to justify selling even more of it off. David Cameron admitted that his austerity was used to shrink the state. This latest one is for the same reason. They just use the state of the economy as an excuse, but it's not the reason. The banking crisis, oh, Labour left it in a mess. Use austerity as an excuse. Right now, same thing. They can't blame Labour. They'll have to blame themselves, but they'll still say austerity is the answer. It's not the answer. The reason is Tory ideology. They want to shrink the state. This is how they think they can justify it. But there we are. Those are my thoughts. Let me know yours in the comments below. I hope you found the video interesting. If you did, please click the like button if you'd like to support the channel further, the join button for memberships, and until next time, I'll see you later.